So, Mike, if I'm wanting to get started with real estate investing, this seems like an interesting time to do that. Like, what's going on in the real estate community, and what do people need to know about, like, the specific things that are happening right now in the world?
Well, I think that's a great point because there's so much happening, and some fear is creating some opportunities, but it's also pushing some people away from this whole industry. So I think it's like one of the most valuable times to get in real estate investing because as the Fed, we talked about this before, is tightening everything. Banks are starting to lend less. As those things happen, there's just better deals out there. There's going to be some really, really good deals where you're going to be able to create the wealth you want, the income you want. So getting into it now, understanding and going through some knowledge-based learning. How do you set up your realtors? Where do you find your deals? How do you calculate your ARV? Getting all that training in over the next 90 days or so, figuring it out is vital because next year, the year after, if everything keeps going the way it is, there's going to be so many opportunities that were not there before, and there's going to be a smaller pool of investors who can actually take advantage of those.
Tell me how that works. Like, if things are tightening up, why does that mean that there will be more opportunities?
For number one, when we look at the money side from both as an investor and as a consumer, because the consumers are the people who own the homes who are going to have to give up those homes for a discount. And on the other side, when we're looking at it for money for us to invest, once again, leverage is key to real estate investing. It is why we can make money from nothing. Anybody could do this, create the generational wealth. When the Fed does what it does, it shrinks the money pool. It shrinks what's available for everyone. So all these lenders, all these banks, we call it they swim upstream. They start lending to the best of the best, and they kind of forget the rest. Banks are being pushed to where they can only lend a portion of what they could before. Investors in the real estate in Wall Street are also doing the same thing. Here's an example. One of the largest private lenders out there, they used to lend on ARV, which means you would get more money from them, more leverage from them to buy deals.
What does ARV stand for?
ARV stands for after repair value. So if you're into real estate investing, you're buying something under market, undervalued, you're putting some money into it and you're either going to keep it or you're going to sell it. But it's all about buying properties that are undervalued, fixing them up and creating wealth for yourself, equity. So let's just say, for example, you buy a house for $250, you put $50 into it, and when it's all said and done, it's worth $400 now. So ARV is the $400. It's the number that it's going to be worth after you bring the property up to market.
Gotcha.
Lenders in the past would lend off of a portion of the ARV. So if it's a $400,000 property, they're lending you off the ARV, the $400,000, and let's just say it's 75%. So they could lend you up to $300,000. If you do the math there, that's the $250 purchase, the $50,000 rehab. Typically, the big private lenders always wanted you to have 10% in. So they weren't going to lend you the $300, but it's going to be very close. But now let's look at if they're lending off of LTV instead of ARV.
Oh, what's that? LTV?
LTV is loan to value. So that's the $250 purchase and the $50,000 you're putting in. They don't care what it's going to be worth in the future. So they're basing their loan off of the $300,000, and they're only going to lend 75% of that.
Okay.
On ARV, they were going to lend on $400. On LTV, they're only going to lend based on $300.
And that's like what it would look, what the property is valued at once it's all fixed up versus right now.
Right now.
Okay.
So in that case, they're going to lend you somewhere between $275 and $300 when they're going off ARV. In this market, since they're going off of the cost, they're going to probably only lend you up to like $225,000. So as you can see, there's somewhere between a $50,000 and a $75,000 difference on what they're going to lend now. So they're just being tighter. They're lending less money. They're charging a little bit more and they're lending you less. So what that means is there's a smaller pool of investors, people buying, who could qualify for those deals. So maybe the deal flow stays the same, but there's only 20 or 30% of the investors out there who prepared themselves, who got them in a situation where they could still be buying in this market. So there's just going to be better deals for the people who could buy and buy quickly.
I hear you. So you're saying like they're only going to, as things tighten up, as the Fed continues to tighten things up, there's only going to be money since the banks are swimming upstream, loan providers are swimming upstream. There's only going to be money for the best of the best. But you're saying if you prepare yourself, you do a little bit of your homework, you can be one of those best of the best.
Correct. If you want to create the wealth, the income from real estate investing, you have to put a little bit of effort behind it. And those people who do will be rewarded. They will be rewarded when the times are a little bit tougher. When there's fear in the street, that's when most people are running. So some of this will be based on people can't qualify the investors, but some people are just scared to get involved.
Yeah.
And when you buy when the property values are low, even if rates are a little bit higher, because we're all hoping or knowing somewhere in the future rates will come back down a little bit. They're not going to come back to where they were.
Yeah, I'm hoping.
Your values will go back up. So the people who are positioned correctly can take advantage of this, who stay with it, make sure they have some money, because in both cases here, you had to put in more money. So make sure you have some more money available. Make sure you are one of the people who have a good credit score, good business history. You want to be one of those clients that these people are actually going after, the private money, the banks, whoever's still lending money. You want to make sure you are attractive to them, because they're going to be a lot pickier than they were just, 6 months ago, 12 months ago.